BloombergQuint. Early in the year, and we're diving straight into Budget 2021, a particularly difficult budget. The surface of the economy is looking a lot better than it has in the last many months, but lots of cross currents. Sajjid Chinoy, Chief India Economist at JPMorgan, described it best in recent writing, saying that India's faster than expected rebound is encouraging, but given labor market pressures and the prospects of a K-shaped recovery, the economy will need to be carefully nurtured and stoked. The budget presents a crucial opportunity to make a big down payment towards that end. Sajjid joins us today to kick off our series of budget discussions. Sajjid, firstly, thank you. Really appreciate your time. And I will go into what went behind that conclusion of your recent writings. So I'll start by asking you what you make of the macro environment. I think more than any year, this year, judging it correctly will perhaps be most important to frame an appropriate budget.
You're exactly right, Ira. Good afternoon. So a couple of things. One is that, since we last spoke in September, the macro environment has clearly improved. The growth contraction that we expect this year is now 6.5%, which is less than the CSO's advance estimate. My sense is that when they revise this, it'll be revised to reflect a shallower contraction, and much less than the double-digit contraction that people had envisioned as recently as 3 months ago. What's changed? I think two things. One is India has dodged a bullet when it comes to COVID. We're seeing that other countries in the world have been beset by second waves and third waves. India has seen mobility rise consistently over the last 3 months. And in fact, COVID cases and COVID deaths are down 80% compared to their September peaks. What's really surprising in a positive way is the cumulative death toll in India. Total deaths per million are about 110. This is less than half the emerging market average and almost 1/10 the developed market average. So the fear factor that we had built in for households has dissipated much sooner, and we've seen a relatively more rapid normalization of activity. Our sense is by October, activity, private sector was about 95% of pre-pandemic levels. It's been inching up since then. Secondly, I think the long-awaited fiscal kick has begun. November, we saw 50% growth in expenditure by the center. The states, remember, are still contracting. So this is a central fiscal impulse. And December, the liquidity numbers suggest another big move by the center. So to the extent that this marks a strategic fiscal change, I think both these factors have contributed to these growth upgrades. And I think we'll end the year at about a 6.5% below. But Ira, a better than expected recovery is not inconsistent with medium-term scarring. And I think many analysts will look at this year and say, well, we're out of the woods. And I think we cannot afford to get complacent because you just have to read the tea leaves. We've discussed before that this has been a recovery led largely by profits, and the labor market has still got meaningful scars. If you look at the CMI labor survey, 18 million jobs have still been lost. You look at the PMI surveys, labor employment is lagging output and new orders. You look at NREGA in December, still 50% more households demanded NREGA work, 26 million compared to 17 million. So all indications are that the labor markets actually has experienced meaningful pressure, and these scars will show up in the coming quarters. So I think the good news is the near term looks more encouraging. Where we need to remain very cautious is we should not conflate a better than expected performance in these quarters with the fact that the medium term has been preserved. That will still need to be protected. And this is where the budget becomes really important. I know we'll talk about the details, but it's really important that the expansionary fiscal impulse we're seeing in the next 6 months continues into next year.
Okay. And I'll come to that. Just two follow-up questions. So one on the current levels of growth, and there's a chart that you had put out on mobility increasing, significantly. So one would assume that into next year, some of the impetus that we have seen in the early months continues, irrespective in some ways of what happens on the virus front or the on the vaccination front.
That's right. I think the one thing we really need to be careful about is avoiding another wave. There is a more dangerous mutant now. We need to guard against that risk. If we can avoid that, I think what you'll see is on consumption, very bifurcated dynamics. We've seen this recovery. When I talk about a K-shape, the top 10% have had their incomes preserved. They've got fuel in the tank because their savings rates were forced up for 2 quarters. And we're seeing that pent-up demand be expressed now. The bottom 20 or 30% have seen a more permanent shock in terms of income losses, wage hits. Now, what are the macro implications of this K?
Yes.
Well, I think it's important not to conflate the level of consumption with the change and not to conflate a transitory phenomenon with a more permanent phenomenon. What do I mean by that?
Yeah.
The upper class has benefited, but it's a one-time effect. Their balance sheets have improved by virtue of a 2-quarter increase in their savings rates. So that sugar rush is going to play out over the next few quarters and will clearly drive consumption. But that's a one-time phenomenon. What we're seeing at the bottom is, of course, their share of consumption is much lower. But to the extent that you've perceived a permanent income hit, you've lost your job or your wages come down, that is a recurring effect over time. The second way to think about this, and this is not unique to India, is COVID has essentially around the world ensured that the relative share of income has moved from the bottom to the top. And every dollar that moves from the bottom to the top, the marginal propensity to consume is actually lower because the MPC is much higher at the bottom of the pyramid. So we need to keep this in mind that we're experiencing a 2-quarter sugar rush, but policy has to anticipate and look beyond that. Where will the economy be in June? And at that point, some of these labor market scars may actually begin to show up. You can see this, in the high frequency data quite easily. Look at the auto sales market. Just look at registration data because that's the cleanest measure of final sales. You see 4-wheelers between October and December actually grew 4% over last year. But 2-wheelers, which are a barometer of the lower end, contracted 15%. So you're seeing a very clear bifurcation in consumption patterns.
Okay. So as the government sits down to make the budget, they already have, but just as a matter of phrase, they would be mindful of the fact that this consumption pickup that we have seen will flatten out at least towards the pre-COVID trajectory, which was already a slowing trajectory, if not more.
That's exactly right. So we have to look at the drivers of demand here and say, what's going to drive demand when this pent-up demand goes away? As you said, consumption had begun to slow even before COVID. Part of that was because a lot of households were borrowing to consume, right? And when you're hit with a permanent income hit, your inclination to borrow to finance consumption becomes lower. So we should not expect that on a permanent basis, if incomes have been damaged, that consumption is going to snap back up. I think where we could get an upside surprise is exports. The blue wave finally came through with the Democrats winning both seats in Georgia. We now believe with the Democrats, taking control of both the Senate and the Congress, that you'll get another $900 billion fiscal stimulus in the coming months once the Biden administration takes over. So our expectation of US growth has increased materially over the last 3 or 4 months. We now expect by 2022 that the US is back on to its pre-COVID trajectory, which is really quite something given where the economy was 6 months ago. So I think what you're going to see is globally, to the extent that you're getting more fiscal stimulus from the US in the coming months, central banks will remain very accommodative. You will get some global tailwinds there. The question for India is going to be, will a more favorable global environment and a 2-quarter consumption increase be enough to stoke investment? That's the $1 million question. Because if we get any kind of investment revival, I'll be much more comfortable about the future. That creates jobs, that gets you into a virtuous cycle. If we cannot bank on investment picking up because of exports and this temporary consumption revival, that's where public investment really needs to kick in. And I've been saying this for the last year, and I'll say it again, that this is India's New Deal moment. We cannot leave our investment revival to chance. Public investment over the next 2 to 3 years has to play a lead role in stoking aggregate demand.
Okay, let me dive straight into the budget then, Sajjid. First, a little bit of numbers. So what is your anticipation of where this year's fiscal deficit will end at? What you expect next year's number to be, but also help us understand what would define a continued expansionary fiscal stance? It won't just be the headline deficit number.
You're exactly right. So, before we get to the numbers, budget strategy, what are the 2 objectives and constraints here? One is because of the better than expected GDP performance, debt to GDP will be a little bit lower than we had feared at the end of this year. So debt to GDP is going to be about 85% at the end of the COVID year. Now that's still very elevated, though global debt to GDP is 100. So we have to put this in context. So, they say a sufficient condition for fiscal unsustainability is a monotonic rise in debt to GDP over the next 5 years. which means a necessary condition for fiscal sustainability is for the debt to GDP trajectory to come down. We should not focus on levels. We should focus on the trajectory. So the first thing we need to do as we plan our budget is say, what is the fiscal deficit path going to be over the next 3 years such that debt to GDP gradually comes down from 85? It will definitely come down next year because nominal GDP will be 15 or 16%. The question is FY23 onwards. And there, Ira, just to make the point, and I'll answer your question in a second, the key here is nominal GDP growth. You can run a lot of simulations and you find if nominal GDP growth over the next 5 to 6 years is 10% every year, which is real GDP growth of about 7%, then the debt to GDP of 85% at the end of this year will gradually asymptote towards 80. We'll get to 80 by the end of 2030. If nominal GDP flatlines at 8%, which is real of 5, then even if you have a very aggressive consolidation, debt to GDP keeps rising monotonically from 85 towards 9. So the key to debt dynamics is going to be where does 5-year nominal GDP settle? And that's why thinking about next year's fiscal impulse is so important. So I think that's the medium term, I think, strategy. The objective for next year has to be, how do I impart an expansionary fiscal impulse, which I define to be higher expenditure to GDP, even as the headline deficit is brought down. So ideally what you want is expenditure to GDP going up next year and the central fiscal deficit coming down. To give you some numbers, because of the higher spending in November and December and the expectation that continues till March, we now think the central government's expenditure is going to be about 14.8% of GDP, up from 13.2%. So that's about 1.5, 1.6% of GDP higher. Remember, the states are contracting, so the consolidated number is going to be smaller. And the objective will be, how do I maintain that 14.8% and actually push it up by another 0.5% or 0.7%? Because I think anything more than that is not realistic from an absorptive capacity perspective. Sure. So the way you can do both things is to actually have a large infrastructure push, which we talk about, and that drives higher expenditure next year, but pay for that entirely by aggressive asset sales. Right? So if we can finance higher expenditure through asset sales, especially given where global equity markets are, global liquidity, domestic asset prices, I can't think of a better moment where, given the gulf between the real economy and asset prices, that we should take advantage of that arbitrage. So once one approach is higher expenditure to GDP financed by asset sales. How do you then get the consolidation? Well, here's where the numbers are important. When all is said and done, it's likely that gross tax to GDP will only be down at the central level by about 0.1. You could have a situation where gross tax to GDP was 9.9% of GDP. It'll come down to 9.8. Why is that the case? Because excise taxes, the petroleum price increases, have made a huge delta this year, which is about 0.7% of GDP. Now, if you take excise taxes out, other taxes seem to have fallen by about 0.8% of GDP. The reason I'm going into so much detail is, if the economy picks up next year, these automatic stabilizers will kick in to about 0.8% of GDP. So one way you can achieve the consolidation is by letting the automatic stabilizers play out. Tax to GDP could go up by about 0.8% of GDP. And given the formalization of the economy, that's going to be net additive for taxes. So if you put another way, before the crisis began, gross taxes were 9.9% of GDP. If you take the excise duties out, they were 8.7. This year, netting out the excise duties, we're at about 7.9. Next year, you would expect that net of excise duties, which hopefully will remain the same, that you're back up at closer to 8.7. So to summarize what I'm saying, you can achieve the headline consolidation by relying on the 0.8 to 1% of GDP in automatic stabilizers through higher gross taxes, and you can impart the expansionary impulse through higher asset sales.
Okay. A question on the medium-term sort of fiscal reset as well before I dive into the infrastructure side. I guess the Finance Commission will give us some sort of a
Yes.
roadmap. There's been talk of a range, etc. But honestly, given the number of resets we have seen, we take it for what it is. Perhaps at least in letter, maybe not entirely in spirit.
Which is why I was saying, in the midst of such a big storm with so much uncertainty, it's unrealistic to peg debt to GDP targets to say where should debt to GDP 3 years or 5 years, which is why I began by saying more important than some abstract level of debt over the next 3 or 5 years is the trajectory. If India can ensure that the 85% of GDP debt begins to come down over the next 4 to 5 years, that's, I think, a necessary condition for sustainability. And we should just start by having a series of fiscal deficits that are credible, consistent with a falling debt to GDP. I think that will be a good start on the fiscal front.
Okay. Sajjid, this infrastructure push that everyone has now talked about for months. So there are two parts to my question. One is that perhaps actually, late this year, early next year is the right time to do it because mobility is improved. The ability to sort of go out and work on these projects is a little bit better. But you're convinced that there's enough of a pipeline which can take off and start paying dividends even in, say, the next year or towards the end of next year?
I think so. I mean, we're a country with a large infrastructure deficit. I can't imagine that we can't identify projects. Okay, not all of them may be shovel ready, but over the course of a year, they certainly can be. So I'm not arguing that this is a 4-quarter push. This has to be a 3-year push. I think we have to recognize that private investment is going to take time to recover. Utilization levels were 70% for 2 consecutive quarters before COVID. This is the first time in the RBI's Abacus survey that private investment was below 70% for 2 consecutive quarters since 2008. So this has to be a strategy to say over the next 3 years, if public investment can drive growth, that creates time and space for private investment to pick up. I mean, these projects have large multiplier effects. They increase demand. They are labor intensive for the most part. So the labor market scarring that I spoke about will be mitigated through that. And they increase medium-term competitiveness. So for me, this is a win-win-win. Now, to the extent that the global economy picks up, that's an added bonus. But given the volatility in the global economy, we can't bank on that as a growth strategy over the next 3 years.
Okay, understood.
It'll have to be public investment driven.
Okay, and the only way to finance that is large disinvestments.
Well, the only way to finance that without imparting a negative fiscal impulse. So I think the peculiar challenge this year is how do you reduce the fiscal deficit without imparting a negative fiscal impulse? And there's only one way to square that circle, which is you finance the extra expenditure through higher asset sales. Any other way, if you're raising taxes or tightening compliance, that's going to result in higher tax to GDP, right? Or you have to cut expenditures. Yeah. So you want to do it where you're relying purely on automatic stabilizers and asset sales. I mean, this may be too cute a solution, but frankly, given these unique times, we'll have to be very creative. The risk is going to be if we tighten too soon next year, right? And we can't achieve that 7% growth over the medium term, then the tightening doesn't help us from a debt sustainability perspective, because if we don't get that 7% medium-term growth, debt to GDP is going to go up in any case.
Absolutely. What's the trade-off between government expenditure on, say, infrastructure, job-generating infrastructure programs versus, what was earlier demanded this year, which was, sort of cash transfers or anything to support
yes.
the vulnerable section of society, which, as you described, has certainly taken a disproportionate hit?
I think conceptually we must distinguish between these two. NREGA, for example, is always meant to be unemployment insurance. It's meant to be insurance for 3 months or 6 months if you have a bad drought or you have a shock, right? What we're looking at is potentially a more chronic problem. And so any insurance mechanism can't solve a multi-year problem, right? And therefore, you really need job creation to mitigate the labor market stress. A 3-month NREGA or 6-month NREGA, urban or rural, will not solve that. The second reason is behavioral. What we will see also in some sections of society is precautionary savings going up. Now, precautionary savings rise because of uncertainty. And the only way to mitigate that uncertainty is to give people a job. Right? The uncertainty won't go away if you give them cash transfers for 3 months or 6 months. It's only when they have the conviction of a permanent job will they reduce their precautionary savings and spend more? So I think NREGA was, in fact, as we found out, the only automatic stabilizer India has. Its value came through. Allocations have gone up. I think it's important that continues over the next 3-6 months. Demand for NREGA is still high. Not all of it is met. But from a 3-year perspective, we have to now move from insurance to job creation.
Okay, understood. Sajjid, just a question on some of these suggestions that have been thrown out during the course of the year, urban jobs, guarantees, etc. But perhaps this is not the right time to set up new programs with the expectation that they will pay dividends right now. Sure, if in the long term we decide that those are directions we want to go on, maybe, but we should stick with what we have in terms of pipelines to push through. Really.
For multiple reasons. One is timing. You need to impart the support now. New programs will take time to develop. Number two, I'm a little bit nervous about urban unemployment insurance, because to the extent that becomes a magnet to attract more migration from rural to urban, because now people say, I'm going to look for a job. If I can't find a job, at least I have something to fall back on. That's going to increase the infrastructure stress on our cities. And thirdly, we already have an infrastructure in place that can work quite well, which is cash transfers. So if you've got a rural infrastructure program for the rural, and you've got cash transfer that you can quickly impart as insurance, there's another shock to urban folks. Why not we rely on that? When you have two different unemployment insurance programs, there's a lot of tension between them. They have to move together, because the risk is, if they're not moving in tandem, you create distorting the migration decision from rural to urban, urban to rural. So we want to avoid distorting the labor market further or putting more pressure on urban infrastructure, which is already bursting at the seams. I would rather say use cash transfers, like many countries in the world have, in the event of a shock, and build urban infrastructure, which gives you the same thing. It actually creates jobs, provides support, and improves productivity.
Okay, we're having a little bit of connectivity problem, but Sajjid, I have 2 more questions before I close off. One is, basic the spend on the vaccination program. Whether that would sort of be ring fenced from the regular budget. Probably not. They would have to find the resources within the budget, right?
That's right. And if you do the math, this is not backbreaking at all. Right? Okay. So I don't think the fact that central and states have to pay for the vaccine, or a large fraction of the population, is going to materially change the budgetary math.
My last question is more, broad-based on the fiscal monetary sort of interplay of those 2 aspects. Next year, the government will also have to sort of remember that the kind of extraordinary support that they managed to get from, liquidity, partly because of monetary policy, partly because of the way the current account moved, as you had highlighted earlier, will not be there. So will monetary policy and the likely stance next year also have to sort of, inform the budget and at least the borrowing program?
Absolutely. I think we need to see cohesion in fiscal and monetary. Monetary was the prime mover in 2020. But you said, almost by definition, some of those exceptional interventions will progressively have to be reversed over time, because if you have that continuing beyond a certain time, you're creating financial stability risks down the line as well. So I'm referring to liquidity. We've got about 8 trillion in the system. The CRR reversal in March will take away about 1.4 trillion. So we still have about 6.5 trillion. And I think over time, some of these exceptional measures will have to be gradually and non-disruptively weaned away. The good news, I think, the first piece of good news is the economy is doing better. The second piece is we're seeing food prices come down. And so our average inflation between January and June is now between 4.5% to 5%. This will give the MPC much needed time and space. You'd rather have the RBI electively withdraw some of these measures slowly over the course of the next year, so it's non-disruptive, rather than be forced to do so cold turkey under the pressure of rising inflation. But the larger point still holds. Monetary has done what it could do. Monetary will progressively and slowly have to reverse, so that we don't make a type 2 error and create financial stability risk down the line, which means the baton will have to pass on to the fiscal in 2021, as counterintuitive as that may seem. In a year where the consolidated deficit ends up at 11.5%, people will say, what more do you want? Well, what you want is the headline deficit to come down, expenditure to go up, and the RBI to gradually wean away. One risk I want to just highlight is, I think the global economy will be supportive, but we've seen commodity prices rise very sharply over the last 3 months. China is doing well. The US is going to have another large fiscal stimulus. So the central bank will have to be vigilant about what happens if oil prices or commodity prices go up. We've seen input prices rise in the PMIs. If the economy is recovering, will pricing power come back? What happens to core inflation? There are a host of delicate questions that the central bank will have to encounter, which is why I think it's important now the budget takes the lead in providing support in the coming quarters.
All right, Sajjid, that sets us up perfectly for a difficult budget. Really thankful for your time. Appreciate you sharing your thoughts with us on BloombergQuint. I apologize to the viewers for slight issues on the connectivity, but you do go to BloombergQuint.com. We'll get the transcript up very soon. Thanks so much for